Welcome back to Lamb's Cryptoverse. Today, I'm going to talk to you about what the heck happened yesterday and today. We had the CPI and PPI that came out. What the heck happened? Stocks had the biggest losing day since June 2020. The S&P was down 4%, the Dow was down 4%, something like 1,300 points, and the NASDAQ was down over 5%. And I don't even want to tell you about Cathie Wood stocks. Her ARK funds got cremated. So what's the worry? Why is everyone all of a sudden worried? Well, let's go back. The market had been going up day after day after day. They had been thinking that maybe we've got a Goldilocks economy going on here. And if there's a Goldilocks economy, there's a hope, perhaps a hope, that the Fed would pivot and stop raising rates. However, that yesterday's red-hot CPI and today's PPI, it squashed and put an end to that pipe dream. That's just some squirrels out there. So what's going on? Some now are talking about the possibility of a 100 basis point hike. I remember historically, like years ago, it was a big deal if we talked about a 50 basis point hike. Now we're talking about maybe 100. What the heck is going on? And how does this compare to my original framework? Well, here's where I got it wrong. I expected long rates. I'm talking about the 30-year rate, and if there was a 20-year rate or implied 20-year rate, let's include that. But we have the 10-year rate, so I expected those long-term rates to start falling, or by the very least, I expected the yield curve to start declining and inverting, and I expected the 210 rate, the inversion to rise, that spread between the 2-year rate and the 10-year rate. Why? Because I expected the economy to start slowing by now, but neither of the two happened. What I failed to take into account is that this economy is like a fat, big cruise ship. It turns really slowly. Or you could think of it like this. Think of it as like a car accident. But a car accident, when you're in a car accident, it feels like it's happening in slow motion. That's what's going on. So sooner or later, this car accident is going to happen. But for the point right now, for the time being, I should say, it's not happening. But what we do have is inflation data that's outside of the reported CPI and PPI data. Basically, inflation data that's real time. That's showing that inflation is coming down fast. I'll give you some examples. Oil prices are coming down. Gas prices declining, even car prices, even used car prices are finally starting to decline. Those days are going to be over when you could sell your used car more than you paid for it. And even housing prices. Is anyone looking to buy a house? Have you checked mortgage rates lately? They're skyrocketing. They're almost at 6% now. And how about chip prices? When I mean that, what I mean by that, I mean semiconductor chips. Everyone last year and even this year was talking about a shortage of semiconductor chips. If there's such a shortage of chips, why is Nvidia and Intel and other chip companies, why are their stocks hitting new lows? Why? Because we've got double and triple ordering, and now we're starting to see that those orders are starting to evaporate. We're starting to get a glut. Believe it or not, we're moving from a shortage of semiconductor chips to a glut. And that's going to cause prices to go down even more. But the Fed, however, is tone deaf because they're looking at lagged CPI data. And that data is not telling them what you and I seen on the street, that inflation is declining. So for the time being, the Fed's going to keep raising rates until they break everything. And by that, I mean the economy, hedge funds, the housing industry, you name it. Well, thank you all for listening. Please like us and subscribe to us down there. Hit that subscribe button.